Welcome to this Killick Explains video, and welcome to quite a topical subject as usual, which is 3 key numbers for bond investors. People do in financial markets keep an eye on the so-called bond vigilantes. You'll see that phrase mentioned in the media. So what sorts of things would a bond vigilante or someone looking at the bond markets for a clue as what's going to happen next, what sort of things would they be looking at? So why focus on the bond markets? Well, according to Ray Dalio, who's a big figure in this space, CEO of Bridgewater Associates, a billionaire, I think we should be afraid of the bond markets. Now, this is not a video that's meant to frighten everybody watching it, but why does he have that view that bond markets need to be taken seriously? And basically, here is the answer. Number one, they can act as a bit of a forward indicator of potential trouble. I'll show you some signs of how in a moment. They are capable of pretty much bringing governments to a standstill. Basically, if the bond vigilantes get upset, which means they suddenly start asking the government for much bigger returns on the money they've got invested with them, then that can actually sort of lock things up. So governments have to keep an eye on the bond markets. And the bond vigilantes, which is just a catch-all expression for groups of institutional investors all taking a similar view, for example, on government spending or the rate they need to charge the government. Bond vigilantes are constantly in and out of the news, it seems. So what we're going to do is say, what actually would you be looking at that might be an indicator of trouble? Bond yields is one. Credit spreads, whatever they are, is number 2. Those two are connected, by the way. And then something called bond duration and convexity is number 3. And I've called it 3.5 magic numbers because convexity I'm going to cover fairly quickly. Not everyone watching this video will ever need to know in a huge amount of depth what it represents. Okay, jargon busting coming up. So let's start with yields. And let's start with people lending money to the government. The so-called 10-year gilt yield, so lending money to the government over a medium term of 10 years, let's say. What do we conclude if we're a bond vigilante from what's going on here? Well, over here we start with the year 2000, by the way, just ring it, and here we're pretty much up to date. All right, near enough, so I'll make this video in October 2025. So what do we observe? Well, we see basically the amount people demand from the government, so the government needs to borrow money by issuing these IOUs called gilts. The amount people wanted from the government dropped away, way all the way down. So basically the yield was getting smaller, or borrowing, if you're the government, was getting cheaper and cheaper and cheaper until only a handful of years ago, that's happened. All right, bond yields, the 10-year benchmark. What basically does it cost the government to borrow over 10 years? Because don't forget, the government won't go bust and the government can print money. So there's no default risk here. So it's often seen as the benchmark, almost the bottom line rate for 10-year loans, if that makes sense, has suddenly spiked up. Now, do we need to panic yet? Now, some people would say, crikey, over on the right there, things aren't looking good. You know, basically people are getting nervous, so they're forcing the government to pay more and more and more on its debt. But actually, if we were going to be a little bit more sanguine about it, a bit more relaxed about it, we could say, yes, around about the time of the Liz Truss mini budget, the rate accelerated rapidly away from where it had been. But actually more recently, yeah, it is going up, that yield, but not as dramatically. And some people would also say, if we were to look back 50 years, Tim, what does this look like? Where we are now, you know, what does that look like historically? Well, this chart runs out at 7%, okay, and we haven't even got there yet. If I was to put the Bank of England base rate in, okay, which this number is normally above, by the way, historically over 50 years, it's been somewhere up here, all right, 8–9%. So all I'm saying there is some people would say that even having climbed up quite steeply on the right, all that's really happening is the medium-term cost of borrowing, if you're the government, is reverting to something like its long-term normal average. And arguably, it's got a bit further to go. So in that context, some people are a bit more relaxed about what they're seeing, but nonetheless, yields, if you're the government looking to borrow and spend, yields, if you're companies, we'll come to those in a moment, looking to borrow and spend, are important. So with no more ado, let's get rid of those bits and consider what that slide has an impact on. Number one, corporate bond yields. Come back to those in a moment. So once people know what basically it costs the government to borrow over a certain period of time, they can start to look at what a company, which is riskier in most cases, would need to pay to borrow. Asset valuation. Why? Because people take the 10-year gilt yield as the kind of risk-free rate. They say, well, that's probably the lowest anyone can borrow money at realistically in the market because they're the UK government. So we'll use that rate as a reference rate when we're discounting future cash flows to value things like shares, for example. And it's also a forward indicator of saving rates and borrowing rates. Now, this is not what I just showed you, the Bank of England base rate. That's different, but the Bank of England do watch the 10-year gilt yield quite carefully for clues about what they should do with the base rate. And the base rate is the thing that directly influences things like your mortgage rate, for example, what you earn on a savings account, and so on. So that gilt yield number is watched pretty carefully for all sorts of reasons. Now, for those people wondering and wanting a bit, a quick refresher on what is it? What was that number? What I was showing you there, I'll keep this fairly brief because this is not a maths lesson, but what I was showing you there is a thing called the yield to maturity. Some people may have seen this before. All right, just a very quick recap on what that is, using a sleight of hand, which I've noted down the bottom just for pure illustration, because most people can look these things up. They'll never have to actually compute them. What we're basically saying is if you had a 4% bond with 4 years to go to maturity, all right, and you know that whatever the market price, it will be redeemed at par. What that means is if you've lent money to the UK government, they will give you back £100 of par value, if you like, once it gets to redemption. So you know that, and that makes the overall return on bonds quite easy to predict in some ways. But in the meantime, bonds trade in a market, they're IOUs, they're tradable, so the price could move. Now, were it the case that on the day you're looking at the price of an IOU, it's the same as the par value, and you've got a 4% bond, which means it pays a £4 coupon every year, dead, because the coupon's always built on this par value as well, okay? Then you could say, well, the flat yield, as it's called, the pure income yield is 4%, and so is the yield to maturity. Why? Because if the price is 100 and it will be redeemed at 100, there's no capital gain or loss. It is what it is. But chances are this thing will be trading, when you look it up, at something else. So if it's trading at 96, okay, very, very crudely what I'm saying is the flat yield would be the income over the current price of 96, which is 4.2. Okay, but on top of that, if you're buying at 96, something which will be redeemed at £100, you've got a £4 capital gain. And this is the sleight of hand. If you spread that evenly over 4 years, that gives you about an extra £1 a year. Okay, add that to your £4 of income, you've got £5 of income, divide that into the price, and bingo, there's your yield to maturity, which is actually the thing that appeared on that curve or wavy line I showed you just now. Were it trading above par value at the point you buy it, then you've still got a flat yield, this time 4 over 104, which is 3.8. Price is higher, so the yield's lower. All right, and you've got to recognise that when you eventually cash it in, if that's the right way of putting it, you'll be paid back £100 by the government. So you're losing 4 somewhere. Factoring that in gives you an overall yield to maturity, sleight of hand at the bottom, okay, ignoring time value of money, of 2.9. All right, so won't labour that point, but what you're looking at on these charts is usually a thing called yield to maturity. If you are purely buying a bond for the income alone, you might look at something else called the flat yield, but that wasn't presented on the previous chart. Okay, so we'll move on from there. All right, and consider number 2 on my list of 3 indicators to watch for, and this is credit spreads. Now, let's say at the time I'm making this video, sleight of hand again, because it isn't the exact number, I've just rounded, but let's say that the 10-year gilt, the IOU issued by the government, is carrying a yield of 4%. And then you look at a company, basically, and it, on an equivalent 10-year bond, let's say, it has to pay 6% because it's riskier than lending to the government. The gap between those two numbers is quite important. It's called a spread. You can express it in percentage or basis points There's a straight translation between the two. The market quite likes basis points, 1/100%. So you can say the spread is 200 basis points. So what? So far just jargon. What bond vigilantes keep an eye on is that widening or narrowing? In other words, is a company being charged gradually, incrementally more than the government, okay, in order to borrow money? Or is that gap sort of narrowing or widening? You know, in other words, is the gap getting bigger or is it getting smaller? And that's quite important. And on a graph, the way that would look, if we get rid of those scribbles, is something like this. So if the yield is up here and the remaining time to maturity is down here, okay, and you know, a 10-year, let's say 10 years is about there, so 20 out there and 0 down here. All right, were I to look at the government, now, which government, I hear you cry, at the time I make this video, okay, in the US, the so-called yield curve, in other words, the relationship between bonds with different maturities is normal. In the UK, it's inverted because the UK economy is thought to be heading into a stickier patch, if you like. So if I was looking at, say, the US, I'd do something like this. US treasuries, I'll call them. And what I could do is say, I could pick off the yield on that benchmark bond I looked at just now. And then what I could do is look at my company. All right, and I'd see that 200 basis point gap, let's say. All right, now that gap is the spread and you get it at different levels. So on the short term IOUs, you'll get a gap. On the longer term IOUs, you'll get a gap. What bond vigilantes do is they watch what's happening to that gap. If they're getting nervous, if the market's getting nervous about a company's prospects of paying back its debt, that gap starts to widen. All right, if they get more comfortable, it starts to narrow. So credit spreads are the second important thing to watch out for. Now, if we take away those scribbles and we'll move on to, now, fear not too much maths here, in fact, really none at all. Duration and convexity. So the other thing people look at is this. They say, how movable is a bond's price and yield when the Bank of England, for example, change their base rate? Does it move a lot in response or does it not move very much? And that is captured in a thing called duration. Strictly speaking, it is, what does this corporate bond do? What does this bond I'm looking at do when the Bank of England change basically the base rate? And it matters because essentially, if people are nervous, yeah, a change in the Bank of England base rate can be ripple out into quite a big change. That's called a big duration number for a corporate bond. So how sensitive is this IOU to changes in interest rates, basically? And the higher the duration number, and it is a number, so for example, yeah, a 1% change might result in a 4% change in the bond's price, for argument's sake. Duration is just a number. It basically indicates you've got greater price and yield volatility, which sounds to me like greater risk. Okay, so duration captures risk, and the key factors are the longer you have to wait for your money back, the higher duration risk tends to be, and also the lower the coupon rate. So in other words, the longer it takes you to get your money back from this bond, again, the higher that risk duration factor tends to be. So riskier bonds tend to be, when it comes to interest rate changes, those which are long duration and relatively low coupon. Okay, and anyone building a portfolio needs to bear that in mind. Now, I'll just take my minor scribbles off there and we'll move on to consider the final thing, which is a thing called convexity. And in a nutshell, what this does, and I've tried to plot it, I've put the bond yield on one axis and the bond price at the other. What convexity tries to capture is basically this. The reality is, when interest rates change, some bonds act asymmetrically. And the one you want, if you think about it, ideally, is if the Bank of England cranks up its base rate, you want a bond that doesn't really fall too much in price. But on the flip side, if the Bank of England cuts interest rates, you want to capture that upside. You want the bond price to kick up, arguably, and that's called convexity. If you've got, now this is a very crude drawing, without convexity, we'd sort of do that. That would be the kind of relationship. That's meant to be a straight line, by the way. But with what's called positive convexity, and I'm not drawing this very well, you get an effect more like that. And where's this all going? Well, essentially people look at both duration and convexity to reach a conclusion about what sort of contribution a bond might make to their overall returns. Okay, won't say any more about it there. There's a lot more I could do and there's no maths, but I suspect for most people watching, that will suffice. So with no more ado, let's get rid of those scribbles. The triple whammy. Okay, so you are somebody watching the bond markets for signs of trouble. The triple whammy, rising yields. But we did say yields can normalize, and historically maybe that's what's happening. So don't just say rising yields is bad news per se, but it does indicate a direction of travel. Widening spreads, suggesting that companies are being perceived as ever more risky compared to, say, the government, and high duration and or low or negative convexity, because the more positive convexity you've got, arguably the better for the particular bondholder in question. Okay, lots of detail there. If you're wondering where you can find out more about fixed income securities in general and some of the points I've just covered, killickexplains.com/resources has got my videos, my how-to guides, and also historic confidants.